We're joined now by David Waddell, Chief Investment Strategist at Waddell and Associates. He joins us from Memphis in Tennessee. David, nice to have you with us. Thanks for taking the time to join us here on Bloomberg. Let's talk a little bit about the rally that we've had since the start of the year. Do I keep investing money into it? If I'm a portfolio manager trying to sort of get my head above water, do I keep chasing this rally in risk assets?
So I think the market's got this right. I think in December the market had it wrong. The one tell before the drawdown, you mentioned September, we had record sentiment levels among individual investors and also portfolio managers. I mean, we'd just gotten priced to perfection in September. And then when Powell came out and made a couple of verbal foot faults, which new Fed chairs tend to do, we went into this massive sentiment correction, and then the algorithm sort of amplified everything. And so I was supposed to be with y'all, I think, the day before Christmas, and I was very contrarian at that moment, saying we're going to rally. Now, because markets move so fast, we've gotten that rally, and I've become consensus. But there's no recession risk, really. So let's just go back and look at the fundamentals. And, you know, right now we're trading at, what, 14 times forward earnings? Forward earnings are 174, at least in the U.S. So, you know, you could make a case easily for a 15% advance from here, but it doesn't mean it's an easy get. We went from deeply oversold to probably correctly priced here, and traders are just going to have to pick their spots, I think. But overall, the trend is higher.
David, how bumpy a ride is it going to be? The VIX curve is still inverted. That would imply that options traders at least are anticipating that we are going to see some big bumps.
Well, it's difficult because when you get to the late stage of a cycle, your master becomes political, right? So we've got what's going on with trade and fits and starts around that. We've got what's going on with the Fed and fits and starts around that. So as the fundamentals start to dial in, you know, we go from 20% earnings growth to 7%, you know, that margin for error gets a little bit tighter, and so the sentiment is really going to push this market around. So I do think it'll be a sloppy sort of ascent, but we're not near recession. The next signal for everybody to look at is the inversion of the yield curve, and right now we're actually steepening, so that's not near term. So I think you can own the market, you're going to be able to trade around it, and then we need to look for the inversion and start thinking about selling about 6 months after that.
So what about Treasuries then? The 10-year yield is up about 20 basis points in the last few sessions. Is that too rich, David?
You know, I think that's probably correct. Again, we're not going into recession. All we're doing is going from an inflated economic growth rate, thanks to the Trump tax cuts, back to a normal economic growth rate. So, you know, between China growing at, call it 6%, the U.S. growing at maybe 2.5%, we are still, and that's 33% of the world economy, growing rather well. So there's no real reason for the Treasury yields to collapse. I think they got caught up in sort of the algorithmic amplification of that sentiment drawdown.
David, do we get a hit to growth if this shutdown continues and if the prospect for bipartisan leadership at government levels deteriorates?
I don't think it matters. And I also don't think the potential downgrade from Fitch matters. You know, the last time we got downgraded, Treasury yields went down. So I'm just not all that concerned about that. I think this is the histrionics in Washington. It plays out, you know, once a year, apparently. It's just we've got Trump, so his histrionics can be a little bit more exaggerated than others. And really all he's asking for is $5 billion out of a $4 trillion budget. My guess is something gets accomplished.
Well, so I hear you on the downgrade, but what about governance? Because we really are at an absolute stonewall here between the Democrats and the Republicans. Shutdown continues, and there doesn't seem to be any way that either side will relax their demands. Now, you say some amount of money will be given, but how long will it take, and will damage have been done?
Who knows? I mean, this is just another one of Donnie Trump's negotiations, and they're always sloppy, but they tend to reach some sort of, you know, reasonable conclusion. So I'm done handicapping the negotiating style. But what I know is the pressure to reopen the government will eventually reopen the government.
David, we were hearing from Atlanta's Bostic earlier on in the session, and he was pointing to the idea that trade is a meaningful worry for the FOMC right now. It'd be interesting to see whether or not that gets confirmed in the minutes. Is trade the ultimate determinant in the number of Fed rate hikes we get this year? If we get no deal on trade, is it zero? If we get a deal on trade, is it a couple? Is that what's really going to determine things, do you think?
Well, first of all, I hate the dot plot, right? So going ahead and saying we're pre-scripting 2 rate hikes, I think, is inane. Again, I think Powell is sort of acclimating to the job, and so he's dialing in his communication strategy. But if you notice, there are going to be like 8 Fed speakers coming out this week. Bullard, who's in my district, and by the way, I think has it right as rain, says we don't need to raise anymore. I think all of these people are starting to dial in a little bit this pre-scripted course of 2 rate hikes because, as I said, late in a cycle, things get very politically oriented. If we have too much restriction from the federal, too much restriction from the monetary authorities, then we trigger a recession. So the market's a little tender around all of that. My guess is the Fed comes to its senses. There's no real reason to put this economy into recession unless, for conspiracy theorists, you just want to see Donald Trump out of office. But I just don't think that's really what motivates the Fed. So things are okay. They're actually Goldilocks right now. There's no reason to break anything. I think the most important data point from the jobs report was the uptick in the participation rate. That means that there's slack still in the labor force, and the Fed does not need to be aggressive. So my guess is all these people coming out are going to endorse this idea of patience and restraint, and obviously the market likes that.
Yep, minutes coming up a little bit later. Powell speaks tomorrow, and as you say, lots of Fed speak over the next 24 hours. David Waddell, Chief Investment Strategist at Waddell & Associates.